All right, let's jump right into it. Today's explainer is basically your personal consultation on navigating mortgages and, more importantly, keeping literally hundreds of thousands of dollars out of the bank's pockets and in yours. We're going to be using direct data from the Consumer Financial Protection Bureau to show you exactly how the math works. If you've ever felt completely overwhelmed by mortgage rates, loan terms, and just the sheer volume of money involved in buying a home, well, you are in the perfect place. We're going to break the whole shebang down into highly actionable, clear steps so you can truly master your mortgage options.
Here's the agenda for today. 1. The scenario, a $400,000 home. 2. Lever 1, your credit score impact. 3. Lever 2, the down payment difference. 4. Lever 3, compressing your loan term. 5. Lever 4, alternative mortgage loan types. And finally, 6. Sealing the best deal.
Okay, Section 1, the scenario, a $400,000 home.
Now, to make this explainer actually practical, we really need to anchor all these abstract percentages to massive, real-world dollar amounts. So, using current data collected by Carinos for the CFPB from April 2025, our baseline is a $400,000 single-family primary residence. We're assuming a 10% down payment, a standard 700 credit score, and you're looking at a 30-year fixed conventional loan with a 60-day rate lock. By holding this specific scenario constant, you're going to see exactly what happens when you take control of the variables, what I call our 4 levers of wealth.
Section 2. Lever 1. Your credit score impact.
It is honestly shocking how a seemingly small 3-digit number basically dictates your long-term financial future. With a 625 credit score, you could be offered rates that yield an astonishing $671,156 in pure interest over 30 years. Think about that for a second. You are literally paying more in interest than the house is even worth. But by simply improving that score to a 700, the lowest interest rate offered drops your total interest paid to just over $406,000.
That 75-point difference in your credit score, it translates to a jaw-dropping savings of up to $284,000 over the life of the loan. I mean, what could you do with $250,000 kept in your own pocket, rather than just handing it over to a bank simply because you optimized your credit before applying?
So, the absolute crucial takeaway here is that applying with a higher score not only lowers your borrowing costs, but it essentially forces lenders to compete for your business. When your credit is excellent, you aren't just begging for a loan, right? You're a premium customer. You have your pick of lenders, which gives you immense leverage to shop around and demand the absolute lowest possible interest rates.
Moving on to Section 3. Level 2, the down payment difference.
Let's see exactly how having cash on hand builds your negotiating power. Sticking with our baseline 10% down payment leaves you with a $360,000 loan, which could potentially cost you over $600,000 in interest at the highest rate offered. But bumping that down payment to 25%, that completely changes the math. Your loan drops to $300,000, and because lenders now see you as far less of a risk, your interest rate drops too, bringing your lowest total interest down to about $330,000.
By adding $60,000 to your down payment up front, you save up to an incredible $272,017 over the life of your mortgage. You are effectively getting a guaranteed, tax-free return of over $250,000 just by tying up an extra $60,000 at the very beginning of the transaction. That is a massively powerful financial move.
And this brilliantly illustrates how a larger down payment acts as a double threat. First off, it shrinks your principal balance right out of the gate, so you're paying interest on a much smaller pie. Second, it simultaneously secures a lower interest rate from the lender because, well, you have more skin in the game. You're compounding your savings from 2 entirely different directions at the exact same time.
Section 4. Lever 3, compressing your loan term.
The sheer contrast between a 30-year and a 15-year loan is just staggering. On one hand, you have the highest interest on a standard 30-year fixed mortgage, over $600,000 lost to the bank. On the other hand, you have the lowest interest on a 15-year fixed mortgage, which sits at just over $152,000. A 30-year mortgage stretches out your payments to make them feel affordable month to month, but it loses a catastrophic amount of money to time compared to the hyper-efficient 15-year alternative.
Compressing your payments into 15 years yields the most massive savings of all our levers, up to $449,842, nearly $500,000 saved. This right here is the ultimate wealth-building secret of real estate. The faster you pay back the bank, the less they get to drain from your personal net worth.
Now, full transparency here. Yes, your monthly payment will absolutely be higher on a 15-year term. But because you represent significantly less risk to the lender over that shorter time horizon, you actually get a lower interest rate to begin with. This means vastly more of your monthly payment goes straight into your own equity, paying down the principal instead of just vanishing into the bank's profit margins.
Section 5. Lever 4. Alternative mortgage loan types.
A standard conventional loan can be quite costly, carrying over $600,000 in interest over 30 years in our high-rate scenario. But qualifying for government-backed programs like a VA or FHA loan can aggressively drop those rates. Because these specific loans are insured by the federal government, lenders are way more willing to offer you terms that are significantly more favorable than what you might find out on the open, conventional market.
If you meet the personal situation criteria, leveraging these alternative loan types can save you up to $236,553. This is a huge advantage that goes entirely unused by so many borrowers simply because they don't even think to ask their mortgage broker if they qualify for anything outside that standard conventional box.
Keep in mind, there are strict qualifications. VA loans require a U.S. military affiliation, so veterans, active service members, or surviving spouses. If you qualify for this, it is often the absolute best mortgage product on the market, hands down. FHA loans, on the other hand, are a phenomenal tool if you're working with a lower credit score, or maybe have less cash on hand, specifically if your down payment is under 10 to 15%. They can provide a real lifeline to home ownership with lower rates than a conventional loan would ever offer for the exact same credit profile.
And finally, Section 6. Sealing the best deal.
As we near the finish line, we need to look beyond just the raw interest rate to effectively compare your loan estimates. First up, let's talk about discount points. You can actually negotiate these points directly with your lender. Essentially, you're paying a cash fee up front at the closing table to permanently buy down your interest rate. If you plan to stay in the house for a long time, paying a few $1,000s today to lower your rate can save you tens of thousands of dollars over the coming decades.
Next, you've also got to factor in mortgage insurance. If your down payment is less than 20%, almost all lenders are going to require this. It's an added monthly cost that protects the bank, not you, in case you default on the loan. You really need to calculate exactly how much this insurance will cost you over time, as it can severely eat into your budget without building you a single dime of equity. Finally, we have closing costs. This encompasses all those additional fees that pile up: appraisal fees, title searches, origination fees, you name it. Because these vary wildly from lender to lender, it makes it absolutely vital to request and compare multiple loan estimates side by side. You use these estimates to negotiate, basically forcing lenders to match or beat each other's fees so you can seal the true best deal for you. So, now that you've seen the staggering financial power hidden inside these four variables: credit score, down payment, loan term, and loan type, you are completely equipped to take control of your financial destiny. You are no longer at the mercy of whatever the bank offers you first. You actually know how the system works. So the question I'll leave you with today is this: when you finally sit down at that closing table, are you going to let the bank dictate your net worth, or are you going to pull these levers to build your own financial empire? Keep learning, stay focused, and use this blueprint as your roadmap to financial freedom.